Question 1. The efficiency study reveals that a financial advisor in Ontario has identified a personal financial goal that could be significantly advanced by recommending a specific investment product to their clients. While the advisor believes this product is suitable for their clients, they have not yet disclosed their personal financial interest in its widespread adoption. Which approach best upholds the advisor's professional and regulatory obligations in Ontario? Option A. Proactively disclose the personal financial goal and the potential conflict of interest to all affected clients, and obtain their informed consent before proceeding with any recommendations related to the investment product. Option B. Proceed with recommending the investment product, assuming that since it is suitable for the clients, the advisor's personal financial interest does not create a material conflict that requires disclosure. Option C. Rationalize that the advisor's personal financial goal is aligned with the long-term financial well-being of their clients, thereby negating the need for explicit disclosure of the conflict. Option D. Cease offering advice on investment products altogether to avoid any potential conflict of interest, even if clients are currently relying on the advisor for guidance. Correct answer is A. Proactively disclose the personal financial goal and the potential conflict of interest to all affected clients, and obtain their informed consent before proceeding with any recommendations related to the investment product. Explanation. The efficiency study reveals a potential conflict between a financial advisor's personal financial goals and their duty to act in the best interests of their clients. This scenario is professionally challenging because it requires the advisor to navigate a situation where their own financial incentives might subtly influence their recommendations, potentially compromising client trust and regulatory compliance. Careful judgment is required to ensure that client interests remain paramount. The approach that represents best professional practice involves proactively disclosing the potential conflict of interest to clients and obtaining their informed consent before proceeding with any recommendations that might be influenced by the advisor's personal financial goals. This is correct because it aligns with the fundamental ethical and regulatory obligation to prioritize client interests above all else. Specifically, under the Ontario Securities Commission (OSC) regulations, advisors have a duty of care and a duty to act honestly, fairly, and in good faith. Transparency about potential conflicts, as mandated by OSC Rule 31-505 Conditions of Registration, is crucial for maintaining client trust and ensuring that clients can make informed decisions. This approach upholds the principle of putting the client's needs first. An incorrect approach involves proceeding with recommendations that benefit the advisor's personal financial goals without any disclosure, assuming the recommendations are still good for the client. This is professionally unacceptable because it violates the duty of care and the obligation to act honestly and fairly. The OSC regulations require advisors to avoid conflicts of interest where possible and where unavoidable, to manage them transparently. Failing to disclose a conflict, even if the recommendation is objectively sound, deprives the client of the opportunity to assess the recommendation with full knowledge of potential biases, thereby undermining informed consent and potentially breaching OSC Rule 31-505. Another incorrect approach is to rationalize that the advisor's personal financial goals are aligned with the client's long-term interests, thus negating the need for disclosure. This is professionally unacceptable as it represents a subjective interpretation of alignment that bypasses the client's right to independent judgment. The regulatory framework emphasizes objective disclosure of potential conflicts, not self-assessment of alignment. The advisor's personal financial gain, even if perceived as indirectly beneficial to clients, creates a conflict that must be disclosed according to OSC requirements. A further incorrect approach involves ceasing to offer advice altogether when a potential conflict arises, rather than managing it transparently. While avoiding conflicts is ideal, outright withdrawal of service, without exploring transparent management options, can be detrimental to clients who rely on the advisor's expertise. The regulatory expectation is to manage conflicts responsibly, which includes disclosure and consent, not necessarily to abandon the client relationship, if such management is feasible and compliant with OSC regulations. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This involves a critical self-assessment of personal incentives and their potential impact on client recommendations. Once identified, the professional must consult relevant regulatory guidelines, such as those from the OSC, to understand their obligations. The next step is to determine if the conflict can be avoided. If not, the professional must implement measures to manage the conflict, with transparency and informed client consent being paramount. This framework ensures that client interests are protected and regulatory compliance is maintained. Question 2. The control framework reveals that in Ontario, Canada, a financial advisor has a client who has consistently expressed a low risk tolerance and a desire for capital preservation. However, the client has recently expressed strong interest in a specific high-risk investment product that the advisor believes is not suitable given the client's stated profile. What is the most professionally responsible course of action for the advisor? Option A. Immediately proceed with the high-risk product recommendation as the client has expressed interest, assuming the client understands the implications. Option B. Refuse to discuss or recommend the high-risk product and suggest a completely different low-risk investment without further explanation to the client. Option C. Engage in a detailed discussion with the client to explain the product's risks and how they align or conflict with the client's stated risk tolerance and financial goals, documenting the conversation and the client's informed decision. Option D. Recommend a moderately risky product that the advisor deems more suitable, without fully exploring the client's specific interest in the high-risk product. The correct answer is C. Engage in a detailed discussion with the client to explain the product's risks and how they align or conflict with the client's stated risk tolerance and financial goals, documenting the conversation and the client's informed decision. Explanation. The control framework reveals a situation where a financial advisor in Ontario, Canada, must navigate conflicting client instructions regarding investment risk tolerance and a specific product recommendation. The professional challenge lies in balancing the client's stated preferences with the advisor's fiduciary duty to act in the client's best interest, adhering to regulatory requirements. This requires careful judgment to avoid misrepresentation, suitability breaches, and potential regulatory sanctions under Ontario securities law. The best approach involves a thorough, documented discussion with the client to understand the discrepancy between their stated risk tolerance and their interest in a high-risk product. The advisor must explain the implications of the product's risk profile in relation to the client's stated tolerance and financial goals. If, after this discussion, the client still insists on proceeding, and the advisor has fulfilled their suitability obligations by documenting the risks and the client's informed decision, then proceeding with the transaction, provided it is otherwise suitable and compliant, is the professionally sound course of action. This aligns with the Ontario Securities Commission (OSC) Rule 31-505 regarding suitability obligations and the general ethical duty of care owed to clients. The advisor must ensure all conversations and decisions are meticulously documented to demonstrate compliance, an approach that involves immediately proceeding with the high-risk product recommendation, without a detailed discussion about the mismatch with the client's stated risk tolerance, is professionally unacceptable. This fails to meet the suitability requirements under OSC Rule 31-505. Which mandates that advisors must have reasonable grounds to believe that a recommendation is suitable for a client based on their financial circumstances, investment objectives, risk tolerance, and other relevant factors. Proceeding without this due diligence could be construed as a misrepresentation of the product's suitability. Another professionally unacceptable approach is to refuse to execute the transaction solely based on the perceived mismatch, without attempting to understand the client's rationale or educating them on the risks. While the advisor has a duty to ensure suitability, outright refusal without further engagement can undermine the client's autonomy and the advisor-client relationship, potentially leading to a complaint if the client feels their instructions are being disregarded without proper justification. Finally, an approach that involves recommending a different, lower-risk product without fully exploring the client's interest in the specific high-risk product and their reasons for it also falls short. While risk mitigation is important, the advisor must address the client's expressed interest directly and explain why it might not be suitable, rather than unilaterally substituting their judgment without client consultation. Professionals should employ a structured decision-making process. 1. Identify the conflict. Recognize the discrepancy between client instructions and stated risk tolerance. 2. Gather information. Engage in open dialogue with the client to understand their motivations and clarify their understanding of the product's risks. 3. Assess suitability Evaluate the product against the client's overall financial situation, objectives, and risk tolerance, considering all relevant factors. 4. Document thoroughly. Record all discussions, client acknowledgments, and the rationale for any decision. 5. Act in client's best interest. Ensure the final decision, whether proceeding or not, is demonstrably in the client's best interest and compliant with OSC regulations. Question 3. The control framework reveals that in Ontario, Canada, a financial advisor has recommended a new investment product to a long-standing client. While the product offers potentially higher returns, it also carries a significantly higher risk profile than the client has previously expressed comfort with. The advisor believes the product aligns with the client's long-term financial goals, but is concerned about the client's stated aversion to substantial risk. Which of the following represents the most professionally responsible course of action? Option A. Advise the client that the product is only suitable for investors with a higher risk tolerance and suggest they consider a different, less risky investment that may not meet their long-term return objectives. Option B. Proceed with the recommendation, but downplay the specific risks associated with the product, focusing instead on the potential upside and the advisor's confidence in the investment. Option C. Conduct a thorough reassessment of the client's risk tolerance, clearly explain the specific risks and potential downsides of the new product, and ensure the client fully understands these implications before proceeding with any recommendation. Option D. Proceed with the recommendation, highlighting the potential for higher returns, and assume the client will understand and accept the increased risk given their long-term financial goals. The correct answer is C. Conduct a thorough reassessment of the client's risk tolerance, clearly explain the specific risks and potential downsides of the new product, and ensure the client fully understands these implications before proceeding with any recommendation. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, must navigate the ethical and regulatory complexities of recommending a product that, while potentially beneficial, carries a higher risk profile than the client initially expressed comfort with. The professional challenge lies in balancing the advisor's fiduciary duty to act in the client's best interest with the client's stated risk tolerance and the need for full disclosure. Misjudging this balance could lead to regulatory breaches, client dissatisfaction, and reputational damage. The best approach involves a thorough reevaluation of the client's risk tolerance and a comprehensive explanation of the product's risks and benefits, ensuring the client fully understands the implications before proceeding. This aligns with the Ontario Securities Commission (OSC) regulations, particularly those concerning suitability and know your client (KIC) principles. Advisors have a fundamental obligation to ensure that any investment recommendation is suitable for the client, considering their financial situation, investment objectives, and risk tolerance. This requires not just obtaining initial information, but also actively confirming and updating this understanding, especially when considering a product that deviates from the client's previously expressed comfort level. Transparent and detailed communication about the product's specific risks, potential downsides, and how they relate to the client's stated tolerance is paramount. An approach that proceeds with the recommendation without a detailed reassessment of the client's risk tolerance and without ensuring complete understanding of the product's specific risks is professionally unacceptable. This fails to uphold the advisor's duty of care and suitability obligations under OSC rules. Recommending a high-risk product based solely on the potential for higher returns, without adequately addressing the client's stated comfort level, constitutes a breach of trust and regulatory requirements. Another professionally unacceptable approach is to dismiss the client's expressed concerns about risk as a minor inconvenience, prioritizing the potential for higher commission or the advisor's own assessment of the product's merits over the client's stated preferences. This demonstrates a disregard for the client's autonomy and a failure to adhere to the core principles of client-centric advice mandated by regulatory bodies. The professional reasoning process should involve 1. Actively listening to and acknowledging the client's stated risk tolerance. 2. Conducting a detailed review and, if necessary, reassessment of the client's risk profile, especially when considering a product that may exceed their comfort zone. 3. Providing clear, comprehensive, and unbiased information about the product, including all associated risks, potential downsides, and how they align with or diverge from the client's risk tolerance. 4. Ensuring the client demonstrates a genuine understanding of these risks and provides informed consent. 5. documenting all discussions, assessments, and decisions thoroughly. Question 4. The control framework reveals that a financial advisor in Ontario, Canada, is working with a client who expresses a strong desire for aggressive growth investments. However, during discussions, the client demonstrates a limited understanding of market volatility and the potential for substantial capital loss. Considering the regulatory obligations in Ontario, which of the following approaches best aligns with professional standards and client protection? Option A. Proceed with aggressive investments as requested by the client, assuming their stated desire overrides any concerns about their understanding of the risks. Option B. Politely decline to offer aggressive investment advice and instead recommend only very conservative investment options, regardless of the client's stated goals. Option C. Invest the client's funds aggressively while providing only a brief, general overview of potential risks without confirming the client's comprehension. Option D. Conduct a detailed risk tolerance assessment. Clearly explain the risks and potential outcomes of aggressive investments, and ensure the client fully understands these before proceeding with any recommendations aligned with their stated objectives. The correct answer is D. Conduct a detailed risk tolerance assessment. Clearly explain the risks and potential outcomes of aggressive investments, and ensure the client fully understands these before proceeding with any recommendations aligned with their stated objectives. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, must navigate conflicting client instructions regarding investment risk. The professional challenge lies in balancing the client's stated desire for aggressive growth with their demonstrable lack of understanding of the associated risks, potentially leading to unsuitable investment recommendations and regulatory breaches. Careful judgment is required to ensure client interests are prioritized and regulatory obligations are met. The best professional practice involves a thorough, documented assessment of the client's risk tolerance, financial situation, and investment objectives, followed by a clear explanation of the risks and potential outcomes of recommended investments. This approach prioritizes the client's best interests by ensuring they make informed decisions. Specifically, under Ontario's regulatory framework for financial advisors, such as the rules enforced by the Financial Services Regulatory Authority of Ontario, FSRA, advisors have a fiduciary duty to act in the best interests of their clients. This includes understanding the client's needs and circumstances, providing suitable advice, and ensuring clients comprehend the nature and risks of the products recommended. Documenting this process is crucial for demonstrating compliance and protecting both the client and the advisor. Recommending investments based solely on the client's stated desire for aggressive growth without a comprehensive risk assessment and clear communication of potential downsides is professionally unacceptable. This fails to meet the advisor's duty of care and suitability obligations under Ontario securities law, potentially exposing the client to undue risk and leading to regulatory sanctions for the advisor. Another professionally unacceptable approach is to override the client's stated desire for aggressive growth and unilaterally select conservative investments. While seemingly protective, this approach disrespects the client's autonomy and can lead to a breakdown in the advisor-client relationship. It also fails to provide advice aligned with the client's stated objectives, even if those objectives require careful management and education. Finally, proceeding with aggressive investments without adequately explaining the potential for significant capital loss and the volatility inherent in such strategies is a clear ethical and regulatory failure. This constitutes a misrepresentation of the investment's risk profile and violates the principle of informed consent, which is fundamental to ethical financial advising in Ontario. Professionals should employ a structured decision-making process that begins with a comprehensive client discovery phase. This involves active listening, probing questions to uncover underlying needs and risk capacity, and clear, jargon-free explanations of investment concepts. Any divergence between stated preferences and demonstrated understanding or capacity must be addressed through education and discussion. Recommendations should then be tailored to the client's confirmed risk tolerance and objectives, with all associated risks clearly articulated and documented. Regular reviews and ongoing communication are essential to ensure advice remains suitable as circumstances change. Question 5. System analysis indicates that an investment advisor in Ontario is discussing investment options with a client who has expressed a strong preference for a particular high-risk speculative fund. The advisor, based on their professional assessment and the client's stated financial goals and risk tolerance, believes this fund is not suitable and that other, more conservative options would better serve the client's long-term interests. What is the most appropriate course of action for the advisor to take? Option A. Advise the client that the preferred fund is too risky and refuse to consider it, suggesting they seek advice elsewhere if they insist on investing in it. Option B. Recommend a diversified portfolio that includes a small allocation to the client's preferred fund, even if it slightly increases overall portfolio risk, to satisfy the client's request. Option C. Proceed with investing in the client's preferred fund as requested, assuming the client is fully aware of the risks and has made an informed decision. Option D. Engage in a detailed discussion with the client, clearly outlining the specific risks and potential downsides of the preferred fund, presenting alternative suitable investments, and documenting the conversation and the client's final decision. The correct answer is D. Engage in a detailed discussion with the client, clearly outlining the specific risks and potential downsides of the preferred fund, presenting alternative suitable investments, and documenting the conversation and the client's final decision. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when the client's preference may lead to suboptimal outcomes or increased risk. The advisor must navigate this by providing clear, objective advice while respecting the client's autonomy, all within the regulatory framework of Ontario. Correct approach analysis. The best professional practice involves a thorough, documented discussion with the client about the risks and benefits of their preferred investment strategy, comparing it objectively with alternative, potentially more suitable options. This approach prioritizes the advisor's duty to provide informed advice and ensure the client understands the implications of their choices. In Ontario, advisors are bound by the Ontario Securities Commission (OSC) regulations, which emphasize suitability and the client's best interest. This includes a responsibility to educate clients about investment risks and to ensure they understand the products being recommended. Documenting this discussion is crucial for demonstrating compliance and protecting both the client and the advisor. Incorrect approaches analysis. Recommending the client's preferred, high-risk investment without further discussion or explanation fails to meet the advisor's duty of care and suitability obligations under OSC regulations. It prioritizes client demand over professional judgment and the client's actual financial well-being, potentially exposing the client to undue risk. Proceeding with the client's preferred investment solely based on their insistence, without adequately explaining the risks or exploring alternatives, constitutes a failure to act in the client's best interest. This bypasses the advisor's responsibility to provide guidance and ensure informed consent, which is a cornerstone of regulatory compliance in Ontario. Refusing to consider the client's preference outright, without attempting to understand their rationale or provide alternative recommendations, can be perceived as dismissive and may damage the client relationship. While the advisor has a duty to advise against unsuitable investments, a complete refusal without explanation or exploration of alternatives might not align with the principles of client-centric advice expected under Ontario's regulatory regime. Professional reasoning. Professionals should employ a structured decision-making process that begins with understanding the client's objectives and risk tolerance. When a client expresses a preference that appears misaligned with their profile or potentially detrimental, the professional's next step is to engage in a transparent and educational dialogue. This involves clearly articulating the risks and benefits of the client's preferred option, presenting suitable alternatives, and documenting the entire process. The ultimate decision rests with the client, but the professional's role is to ensure that decision is made with full understanding and in accordance with regulatory requirements. Question 6. The control framework reveals that a financial advisor in Ontario, Canada, is working with a new client who expresses a strong desire for high-risk, aggressive investment strategies to achieve rapid wealth accumulation. The advisor has conducted an initial review of the client's provided financial information, which suggests a moderate capacity for risk, but no specific details on the client's investment knowledge or experience. Considering the regulatory environment in Ontario and the expectations of EROC, which approach best navigates this situation professionally and ethically? Option A. Advise the client that their desired investment strategy is too risky and suggest they seek advice from a different advisor who specializes in high-risk investments without further engagement. Option B. Proceed with the client's requested aggressive investment strategy, assuming their stated desire accurately reflects their risk tolerance and investment objectives, and document their explicit consent. Option C. Recommend a diversified portfolio of moderately aggressive investments that offer a balance between potential growth and risk, without delving deeply into the client's specific knowledge or experience beyond what was initially provided. Option D. Conduct a detailed assessment of the client's investment knowledge, experience, and true risk tolerance, and recommend suitable investments that align with these factors, even if they are more conservative than the client's initial request, while educating the client on appropriate risk management. The correct answer is D. Conduct a detailed assessment of the client's investment knowledge, experience, and true risk tolerance, and recommend suitable investments that align with these factors, even if they are more conservative than the client's initial request, while educating the client on appropriate risk management. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client who has a complex financial situation and expresses a desire for aggressive, high-risk investments. This situation is professionally challenging because it requires the advisor to balance the client's stated desires with their fiduciary duty to act in the client's best interest, as mandated by Ontario securities law and the regulatory expectations of the Investment Industry Regulatory Organization of Canada, IIROC. The advisor must conduct thorough due diligence to understand the client's true risk tolerance, financial capacity, and investment objectives, which may differ from their initial expressed wishes. The best professional practice involves a comprehensive assessment of the client's financial situation, risk tolerance, and investment objectives, followed by recommending suitable investments that align with these factors, even if they are more conservative than the client initially requested. This approach is correct because it directly adheres to the principles of Know Your Client, KIC, and suitability, which are fundamental to Ontario securities law and IIROC rules. By prioritizing a thorough understanding of the client's circumstances over their immediate, potentially ill-informed desires, the advisor fulfills their ethical and regulatory obligations to protect the client from undue risk and ensure that investment recommendations are appropriate. Recommending investments that are overly aggressive and do not align with a realistic assessment of the client's risk tolerance or financial capacity, despite the client's stated preference, represents a significant regulatory and ethical failure. This approach breaches the duty of care and the suitability requirements, potentially exposing the client to unacceptable losses and violating the principles of responsible financial advice. Similarly, proceeding with the client's aggressive investment requests without adequate due diligence or a clear understanding of the client's ability to withstand potential losses is also a failure. This demonstrates a lack of professional judgment and a disregard for the client's long-term financial well-being, contravening the core tenets of client protection embedded in Ontario's regulatory framework. Professionals should employ a structured decision-making process that begins with a deep dive into the client's KYC information, including their financial situation, investment knowledge, experience, and risk tolerance. This should be followed by a clear articulation of the advisor's understanding of the client's objectives and risk profile. Any divergence between the client's stated desires and the advisor's assessment must be thoroughly discussed and documented. The advisor should then present a range of suitable investment options, clearly explaining the risks and potential rewards of each, and guide the client towards a decision that is in their best interest, even if it requires managing the client's expectations about aggressive returns. Question 7. Governance review demonstrates that a client in Clare has expressed a strong desire to invest a significant portion of their portfolio in a specific high-risk mutual fund, citing a friend's recommendation. As a registered investment advisor in Clare, what is the most appropriate course of action to ensure compliance with the Clare Securities Commission, CSC, regulations and ethical standards? Option A. Proceed with the recommendation without further inquiry, but ensure to disclose any potential conflicts of interest related to commissions. Option B. Conduct a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments before making any recommendation, and then explain the suitability of the proposed fund in that context. Option C. Advise the client to open an account with another firm that may be more amenable to their specific investment request. Option D. Recommend the specific mutual fund immediately, as the client has explicitly requested it, prioritizing their stated preference. The correct answer is B. Conduct a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments before making any recommendation, and then explain the suitability of the proposed fund in that context. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing a client's stated wishes with the advisor's fiduciary duty and the regulatory obligations of the Clare Securities Commission, CSC. The advisor must navigate potential conflicts of interest and ensure that any recommendations are suitable and in the client's best interest, not just what the client explicitly demands, especially when those demands might be ill-informed or detrimental. Correct approach analysis. The best professional practice involves a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments, even if the client expresses a strong preference for a specific product. This approach aligns with CSC Rule 205.1, which mandates that investment advisors must conduct a reasonable inquiry to determine the suitability of any investment recommendation for a client. It also upholds the ethical principle of acting in the client's best interest, which is paramount under CSC's Code of Conduct. By gathering comprehensive information, the advisor can then explain the risks and benefits of the proposed investment in relation to the client's overall financial picture, allowing for an informed decision that is truly suitable. Incorrect approach is analysis. Recommending the specific mutual fund solely based on the client's stated preference without further inquiry fails to meet the suitability requirements of CSC Rule 205.1. This approach prioritizes the client's immediate request over their long-term financial well-being and the advisor's duty to ensure suitability, potentially exposing the client to undue risk or unsuitable investment characteristics. Proceeding with the recommendation without disclosing the potential conflicts of interest, such as if the advisor receives a higher commission for selling this particular fund, violates CSC Rule 301. 2. Regarding disclosure of conflicts. This lack of transparency erodes client trust and is a direct breach of regulatory requirements. Suggesting the client open an account with a different firm that would allow them to purchase the fund without the advisor's involvement, while seemingly deferring to the client's wishes, could be interpreted as an attempt to avoid the advisor's regulatory obligations and fiduciary responsibilities. This approach does not serve the client's best interest and sidesteps the advisor's professional duties. Professional reasoning. Professionals should employ a structured decision-making process that begins with understanding the client's stated needs and preferences. This is followed by a comprehensive fact-finding exercise to gather all relevant information regarding the client's financial situation, objectives, and risk tolerance. Next, the advisor must assess the suitability of any proposed recommendation against this gathered information and relevant regulatory requirements. Finally, the advisor must communicate their findings and recommendations clearly to the client, ensuring they understand the rationale and potential implications, and obtain informed consent. Question 8. Stakeholder feedback indicates that some financial advisors in Ontario may be hesitant to challenge a client's preferred investment strategy, even when it appears to be misaligned with the client's financial well-being. Considering the regulatory framework in Ontario, which of the following approaches best reflects professional and ethical obligations when a client expresses a strong preference for an investment that an advisor believes is not suitable? Option A. Agree to the client's preferred investment strategy, but internally document concerns about its suitability without disclosing these concerns to the client. Option B. Conduct a thorough suitability assessment, explain the potential risks and drawbacks of the client's preferred strategy, and present alternative, more suitable options that align with the client's objectives and risk tolerance. Option C. Politely dismiss the client's preferred strategy, informing them that it is not an option without further discussion or exploration of their reasoning. Option D. Proceed with the client's preferred investment strategy as requested, prioritizing client satisfaction and avoiding potential conflict. The correct answer is B. Conduct a thorough suitability assessment, explain the potential risks and drawbacks of the client's preferred strategy, and present alternative, more suitable options that align with the client's objectives and risk tolerance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when the client's preference may lead to suboptimal outcomes or increased risk. The advisor must navigate this delicate balance, ensuring compliance with regulatory requirements while maintaining client trust and providing sound financial advice. The specific context of Ontario's regulatory framework for financial advisors adds a layer of complexity, requiring adherence to rules governing suitability, disclosure, and client best interest. Correct approach analysis. The best professional practice involves a thorough assessment of the client's financial situation, objectives, and risk tolerance, followed by a clear explanation of why the client's preferred investment strategy, while understandable, may not align with their best interests or regulatory suitability requirements in Ontario. This approach prioritizes the client's well-being by ensuring they are fully informed about the potential consequences of their preferred strategy and the benefits of alternative, more suitable options. It directly addresses the advisor's fiduciary duty under Ontario securities law, which mandates acting honestly, in good faith, and with a view to the best interests of the client. This involves providing advice that is suitable based on a comprehensive understanding of the client's circumstances, even if it means gently challenging their initial preference. Incorrect approaches analysis. Recommending the client's preferred investment without further investigation or discussion fails to uphold the advisor's duty of care and suitability obligations under Ontario securities regulations. This approach prioritizes client satisfaction over client well-being and regulatory compliance, potentially exposing the client to undue risk or suboptimal returns. Proceeding with the client's preferred strategy solely based on their stated preference, without a suitability assessment, constitutes a failure to act in the client's best interest. Another incorrect approach involves dismissing the client's preference outright without attempting to understand the underlying reasons or offering alternative solutions. This can damage the client relationship and may overlook valid, albeit perhaps misinformed, client concerns. It also fails to meet the requirement of providing advice that is tailored to the client's specific situation. Finally, agreeing to the client's preferred strategy while privately believing it to be unsuitable, without proper disclosure of the risks and potential downsides, is a breach of ethical conduct and regulatory disclosure requirements. This misrepresents the advisor's professional judgment and fails to ensure the client is making an informed decision. Professional reasoning. Professionals should employ a structured decision-making process that begins with active listening to understand the client's stated preference and the rationale behind it. This should be followed by a comprehensive fact-finding process to gather all necessary information about the client's financial situation, goals, and risk tolerance. The advisor must then critically evaluate the client's preference against regulatory requirements, specifically suitability and best interest standards in Ontario, and their professional judgment. If a discrepancy exists, the advisor must engage in a transparent and educational dialogue with the client, explaining the implications of their preference and presenting suitable alternatives. The ultimate decision should be a collaborative one, where the client makes an informed choice based on a clear understanding of the risks, benefits, and regulatory considerations, with the advisor having fulfilled their duty to provide advice in the client's best interest. Question 9. The control framework reveals that a financial advisor in Ontario, Canada, is working with a client who expresses a strong desire for highly aggressive investment strategies to achieve rapid wealth accumulation. The advisor has conducted an initial review and believes these strategies may exceed the client's actual risk tolerance and financial capacity, despite the client's explicit instructions. Considering Ontario securities law and ethical obligations, which of the following approaches best reflects professional conduct? Option A. Immediately dismiss the client's request for aggressive strategies and refuse to consider any investments that carry a higher than moderate risk profile, regardless of the client's stated objectives. Option B. Implement the aggressive investment strategy as requested by the client, but only after obtaining a signed waiver from the client acknowledging the high risks involved. Option C. Conduct a comprehensive suitability assessment that thoroughly evaluates the client's financial situation, investment knowledge, and risk tolerance, and then engage in a detailed discussion with the client about the risks and benefits of their desired strategy, proposing alternative suitable options if necessary. Option D. Proceed with the client's requested aggressive investment strategy, as the client's instructions are paramount, and the advisor is obligated to follow them. The correct answer is C. Conduct a comprehensive suitability assessment that thoroughly evaluates the client's financial situation, investment knowledge, and risk tolerance, and then engage in a detailed discussion with the client about the risks and benefits of their desired strategy, proposing alternative suitable options if necessary. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client who has a complex financial situation and a desire for aggressive investment strategies. The professional challenge lies in balancing the client's stated objectives with the advisor's fiduciary duty and regulatory obligations under Ontario securities law, specifically the client-focused conduct rules and suitability requirements. The advisor must ensure that any recommended investments are not only aligned with the client's stated risk tolerance and financial goals, but also that the client fully understands the associated risks and that the recommendations are in the client's best interest. This requires a thorough understanding of the client's financial capacity, investment knowledge, and risk tolerance, which may differ from their stated desires. The best professional practice involves a comprehensive assessment of the client's financial situation, including their income, assets, liabilities, investment experience, and risk tolerance, before recommending any investment. This approach prioritizes understanding the client's true capacity and willingness to bear risk, even if it means gently guiding them away from strategies that might be too aggressive for their circumstances. This aligns with the Ontario Securities Commission OSC Rule 31-505 regarding suitability obligations, which mandates that registrants must have reasonable grounds to believe that a recommended transaction or trade is suitable for the client. It also reflects the ethical obligation to act in the client's best interest, which supersedes a client's potentially ill-informed or overly aggressive requests. Recommending investments based solely on the client's stated desire for aggressive growth without a thorough suitability assessment is professionally unacceptable. This fails to meet the regulatory requirement to have reasonable grounds to believe the recommendation is suitable and breaches the duty to act in the client's best interest. It exposes both the client and the advisor to significant risk. Similarly, dismissing the client's stated desires entirely and refusing to consider any aggressive strategies without a clear, documented rationale based on suitability concerns is also problematic. While the advisor must ensure suitability, outright refusal without engaging in a dialogue to understand the client's motivations and explore potentially suitable, albeit less aggressive, alternatives can damage the client relationship and may not fully address the client's underlying financial objectives. Finally, proceeding with the aggressive strategy without adequately documenting the suitability assessment and the client's understanding of the risks is a critical regulatory failure. Proper documentation is essential to demonstrate compliance with suitability rules and to protect both the client and the advisor. Professionals should adopt a structured decision-making process that begins with a deep dive into understanding the client's complete financial profile and objectives. This involves active listening, probing questions, and a thorough review of financial documentation. The advisor should then assess the alignment between the client's stated desires and their actual capacity and tolerance for risk. If there is a misalignment, the advisor must engage in a transparent discussion with the client, explaining the risks and potential consequences of their desired strategy in relation to their financial situation. The advisor should then propose alternative strategies that are suitable and still aim to meet the client's underlying financial goals, providing clear rationale and documentation for all recommendations. Question 10. Benchmark analysis indicates that a driver planning a 200 km road trip across Ontario needs to estimate their fuel expenses. The vehicle's manufacturer states a highway fuel economy of 7.5 L/100 km and a city fuel economy of 10.0 L/100 km. Current average fuel prices in Ontario are approximately $1.65 per liter. If the driver's historical data shows their absolute worst-case fuel consumption was 12.0 L/100 km during a previous challenging drive, and they want to ensure they have sufficient funds, which of the following calculation methods provides the most professionally sound and financially prudent estimate for their fuel cost? Option A. Calculate total liters needed by dividing the total distance by the city fuel economy, expressed in km/L. then multiply by the average fuel price. Option B. Calculate total liters needed using the absolute worst-case fuel consumption 12.0 L/100 km, then multiply by a hypothetical low fuel price of $1.50 per liter. Option C. Multiply the total distance by a fixed rate of $0.15 per kilometer, derived from an arbitrary assumption, to estimate the total fuel cost. Option D. Calculate total liters needed by dividing the total distance by the highway fuel economy, expressed in km/L, then multiply by the average fuel price. Correct answer is D. Calculate total liters needed by dividing the total distance by the highway fuel economy, expressed in km/L, then multiply by the average fuel price. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent variability in vehicle fuel efficiency and the need to accurately estimate fuel costs for a long-distance trip. Miscalculations can lead to underestimation of expenses, potentially causing financial strain, requiring unexpected stops for refueling, impacting the driver's schedule and budget. The driver must balance the desire for a precise estimate with the practical limitations of predicting real-world fuel consumption. Correct approach analysis. The best approach involves calculating the estimated fuel needed based on the vehicle's average highway fuel economy rating and the total distance of the trip, then multiplying this by a conservative estimate of the average fuel price. This method is correct because it directly addresses the core components of fuel cost: distance, efficiency, and price. The Ontario Highway Traffic Act and associated regulations do not mandate specific fuel cost calculation methods for personal travel, but this approach aligns with principles of prudent financial planning and responsible resource management, which are implicitly expected of all road users. Using the manufacturer's stated highway MPG provides a standardized baseline, and factoring in a slightly higher fuel price accounts for potential fluctuations and avoids underestimation. Incorrect approaches analysis. One incorrect approach is to simply divide the total distance by the vehicle's stated city MPG. This is professionally unacceptable because city MPG is significantly lower than highway MPG due to stop-and-go traffic, idling, and lower speeds. Using city MPG for a highway trip would drastically overestimate fuel consumption and cost, leading to an unnecessarily pessimistic and inaccurate financial projection. Another incorrect approach is to estimate fuel cost by multiplying the total distance by a fixed dollar amount per kilometer without considering the vehicle's actual fuel efficiency. This fails to account for the primary determinant of fuel cost, how much fuel the vehicle consumes per unit of distance. It is an arbitrary method that lacks any basis in the vehicle's performance or current market prices, making it highly unreliable and unprofessional. A further incorrect approach is to use the vehicle's absolute lowest recorded MPG from extreme driving conditions, e.g., heavy towing, steep inclines, and multiply it by the distance, then divide by a hypothetical low fuel price. This is professionally flawed as it uses an outlier, worst-case scenario for efficiency and an optimistic, potentially unrealistic fuel price. This combination would lead to a wildly inaccurate and likely underestimated fuel cost, failing to provide a realistic budget. Professional reasoning. Professionals should approach financial estimations by identifying key variables, utilizing reliable data sources, and applying conservative assumptions where uncertainty exists. For fuel cost estimation, this involves understanding the difference between city and highway MPG, using the manufacturer's highway rating as a baseline, and researching current average fuel prices in the relevant region, Ontario in this case. A prudent driver would then add a buffer to the estimated cost to account for unforeseen circumstances like traffic delays, higher than expected speeds, or price increases. Question 11. Market research demonstrates that a client in Ontario who is preparing for their Clare driver's test has recently admitted to their financial advisor that they have been engaging in reckless driving behavior, including speeding and running red lights, due to stress. The client expresses concern about how this might impact their ability to maintain their driver's license, which is crucial for their employment as a delivery driver. The financial advisor is aware that the client's employment is their sole source of income and that any disruption could lead to significant financial hardship, potentially impacting their ability to meet their financial obligations. What is the most appropriate course of action for the financial advisor in Ontario? Option A. Advise the client to cease all communication with the financial advisor to avoid any potential liability for the advisor, and to maintain client confidentiality. Option B. Discuss the client's driving behavior and financial situation with other financial advisors within the firm to seek advice on how to proceed, without mentioning the client's name. Option C. Discuss the situation privately with the client to understand the full scope of their behavior, encourage them to seek appropriate support or counseling for their stress, and advise them on the potential financial implications of losing their employment due to driving infractions, while also preparing to consult regulatory guidelines regarding potential disclosure if the client remains unwilling to address the issue. Option D. Immediately report the client's admission of reckless driving to the Ontario Ministry of Transportation and the client's employer, citing the potential risk to public safety. The correct answer is C. Discuss the situation privately with the client to understand the full scope of their behavior, encourage them to seek appropriate support or counseling for their stress, and advise them on the potential financial implications of losing their employment due to driving infractions, while also preparing to consult regulatory guidelines regarding potential disclosure if the client remains unwilling to address the issue. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial advisor to balance client confidentiality with the potential need to disclose information that could prevent harm. The advisor must navigate the delicate line between respecting a client's privacy and fulfilling ethical and potentially legal obligations to protect others. The specific context of a Clare driver's test syllabus implies a focus on responsible driving and adherence to rules, which can be metaphorically extended to financial advice, acting responsibly and within regulatory boundaries. Correct approach analysis. The best professional practice involves a multi-step approach that prioritizes direct communication with the client while preparing for potential escalation. This begins with a private conversation with the client to understand the situation fully and encourage them to take responsible action themselves. If the client remains unwilling or unable to address the concerning behavior, the advisor must then consider their professional obligations under the relevant regulatory framework for financial advisors in Ontario. This framework typically mandates reporting to the appropriate regulatory body if there is a significant risk of harm to the client or others, or if the client's actions are illegal or unethical and could impact their financial dealings. The advisor must document all conversations and decisions meticulously. This approach is correct because it respects client autonomy as much as possible, while upholding the advisor's duty of care and regulatory responsibilities. Incorrect approach is analysis. One incorrect approach is to immediately report the client's behavior to the authorities without first speaking to the client. This violates the principle of client confidentiality and can damage the advisor-client relationship unnecessarily. It assumes the worst without seeking clarification or offering the client an opportunity to rectify the situation. Another incorrect approach is to do nothing, citing client confidentiality as an absolute barrier. This fails to acknowledge the advisor's professional duty of care and the potential for harm to the client or others, which may necessitate disclosure under specific regulatory provisions. Ignoring the situation could lead to regulatory sanctions and ethical breaches. A third incorrect approach is to discuss the client's situation with colleagues or other clients without the client's explicit consent. This is a clear breach of confidentiality and professional ethics, regardless of the intent. Professional reasoning. Professionals should adopt a framework that begins with gathering information and understanding the client's perspective. This is followed by a direct, private conversation with the client to address concerns and explore solutions. If the client's behavior poses a significant risk or violates regulatory requirements, the professional must then consult their professional code of conduct and relevant legislation in Ontario to determine the appropriate course of action, which may include reporting to the relevant regulatory body. Throughout this process, thorough documentation of all interactions and decisions is paramount. Question 12. The control framework reveals that a financial advisor in Ontario, Canada, is approached by a client who expresses a strong desire for aggressive investment growth and specifically requests advice on a strategy involving significant financial leverage. Which of the following approaches best demonstrates professional and regulatory compliance in this situation? Option A. Proceed with recommending the leveraged investment strategy based on the client's explicit request for aggressive growth, assuming the client is fully aware of the associated risks. Option B. Briefly discuss the general concept of investment risk with the client and then proceed with recommending the leveraged investment strategy, assuming the client will seek further clarification if needed. Option C. Recommend the leveraged investment strategy based on the advisor's personal conviction that it offers superior returns, without conducting a formal suitability assessment. Option D. Conduct a comprehensive suitability assessment, thoroughly documenting the client's financial situation, risk tolerance, investment knowledge, and ensuring the client fully understands the specific risks and potential consequences of leverage before recommending any investment. The correct answer is D. Conduct a comprehensive suitability assessment, thoroughly documenting the client's financial situation, risk tolerance, investment knowledge, and ensuring the client fully understands the specific risks and potential consequences of leverage before recommending any investment. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client seeking advice on a complex investment strategy that involves significant leverage. The professional challenge lies in balancing the client's stated desire for aggressive growth with the advisor's fiduciary duty to ensure the investment is suitable and understood by the client, given the inherent risks. This requires a deep understanding of Ontario's securities regulations and ethical obligations. The best professional practice involves a thorough, documented suitability assessment that goes beyond the client's stated goals. This approach prioritizes understanding the client's financial situation, risk tolerance, investment knowledge, and the implications of leverage. It requires the advisor to explain the risks in clear, understandable terms, ensuring the client comprehends the potential for substantial losses. This aligns with the Ontario Securities Commission OSC Rule 31-505 regarding suitability obligations and the ethical principles of acting in the client's best interest, which mandates a comprehensive understanding of the client's circumstances before recommending any investment, especially one involving leverage. An approach that solely relies on the client's explicit request for an aggressive, leveraged strategy without independent, rigorous due diligence is professionally unacceptable. This fails to meet the suitability requirements mandated by the OSC, as it presumes the client fully grasps the risks and implications of leverage, which is often not the case. Ethically, it breaches the duty to act in the client's best interest by potentially exposing them to undue risk without adequate safeguards or understanding. Another professionally unacceptable approach is to recommend the investment based on the advisor's personal belief in its potential for high returns, without a formal, documented suitability assessment. It prioritizes the advisor's judgment over the client's specific circumstances and regulatory requirements, potentially leading to a recommendation that is not suitable for the client's individual profile. This contravenes the OSC's emphasis on objective, client-centric advice. Finally, an approach that involves recommending the leveraged investment after a cursory discussion about risk, without ensuring the client's comprehension of the specific mechanics and potential downsides of leverage, is also professionally unsound. This falls short of the obligation to ensure the client understands the investment, particularly the amplified nature of both gains and losses associated with leverage. It neglects the ethical imperative to provide clear and complete information, which is crucial for informed decision-making. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of regulatory obligations and ethical principles. This involves a systematic process of client discovery, risk assessment, and suitability determination, all of which must be thoroughly documented. When faced with complex or high-risk investment strategies, professionals must err on the side of caution, prioritizing client understanding and protection over potential for high commissions or client enthusiasm. The process should include clear communication, verification of client comprehension, and a robust internal review of the recommendation's suitability. Question 13. The control framework reveals that a financial advisor in Ontario, Canada, has a client who expresses a strong desire to invest in a highly speculative and complex derivative product. The client states they are aware of the risks and want to proceed immediately. However, the advisor's initial assessment, based on the client's stated financial goals of capital preservation and a moderate risk tolerance, suggests this product is a poor fit. What is the most appropriate course of action for the advisor? Option A. Conduct a detailed suitability assessment, documenting the client's financial situation, investment objectives, risk tolerance, and knowledge of investments, and then explain to the client why the proposed product may not be suitable, offering alternative investments that align with their profile. Option B, proceed with the investment but emphasize the potential for high returns while minimizing discussion of the significant risks involved. Option C, refuse to discuss the product further with the client, as it clearly does not align with their stated financial goals and risk tolerance. Option D, immediately execute the client's requested investment, as the client has explicitly stated their desire and acknowledged the risks. The correct answer is A. Conduct a detailed suitability assessment, documenting the client's financial situation, investment objectives, risk tolerance, and knowledge of investments, and then explain to the client why the proposed product may not be suitable, offering alternative investments that align with their profile. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client's desire to invest in a complex, high-risk product that may not align with their stated risk tolerance and financial goals. This situation is professionally challenging because it requires the advisor to balance the client's immediate wishes with their fiduciary duty to act in the client's best interest, adhering to regulatory requirements. Misjudging this balance could lead to significant financial harm for the client and regulatory repercussions for the advisor. The best professional practice involves a thorough and documented assessment of the client's suitability for the proposed investment. This approach prioritizes understanding the client's financial situation, investment objectives, risk tolerance, and knowledge of investments. The advisor must then objectively determine if the complex product is appropriate and explain any discrepancies between the client's stated desire and their assessed suitability. This aligns with the Ontario Securities Commission OSC Rule 31-505 Conditions of Registration, which mandates that registrants must deal fairly, honestly, and in good faith with clients, and act in the best interests of their clients. Furthermore, the CSA Staff Notice 81-327 Guidance for Industry on Best Practices for the Sale of Investment Products emphasizes the importance of suitability assessments and clear communication. An approach that immediately proceeds with the client's request without a comprehensive suitability assessment fails to uphold the advisor's fiduciary duty. This is a direct contravention of the OSC's requirement to act in the client's best interest and could expose the client to undue risk, potentially leading to losses that are inconsistent with their financial well-being. Another unacceptable approach involves dismissing the client's request outright without a proper explanation or offering alternatives. The advisor may identify suitability concerns. A complete refusal without engaging the client in a discussion about why the product is not suitable or exploring other options that might meet their underlying needs can damage the client relationship and may not fully address the client's financial objectives. This demonstrates a lack of professional engagement and a failure to provide comprehensive advice. A third incorrect approach is to proceed with the investment based solely on the client's insistence, while downplaying the risks involved. This is ethically and regulatorily unsound. It misrepresents the nature of the investment and fails to provide the client with the necessary information to make an informed decision. This violates the principle of fair dealing and could lead to a situation where the client suffers losses due to a lack of understanding, for which the advisor would be held accountable. Professionals should employ a structured decision-making process that begins with a deep understanding of the client's profile. This involves active listening, probing questions, and objective assessment tools. If a proposed investment appears unsuitable, the advisor must clearly communicate the concerns, explain the regulatory basis for their assessment, and collaboratively explore alternative solutions that align with the client's best interests and regulatory requirements. Documentation of all discussions and decisions is paramount. Question 14. Cost-benefit analysis shows that a client in Ontario is seeking to rapidly increase their capital to meet a short-term personal goal. Considering the regulatory obligations for financial advisors in Ontario, which approach best balances the client's stated desire with the advisor's fiduciary duty. Option A. Immediately recommend a highly speculative investment product with the potential for rapid gains, as this directly addresses the client's stated short-term goal. Option B. Focus solely on the client's expressed desire for quick returns and suggest aggressive trading strategies without a thorough assessment of their risk capacity or the potential for losses. Option C. Advise the client to withdraw funds from their existing stable investments to pursue the short-term goal, even if it incurs penalties and erodes their long-term financial security. Option D. Conduct a comprehensive review of the client's entire financial situation, risk tolerance, and long-term objectives. Then recommend a diversified investment strategy that, while potentially slower, prioritizes capital preservation and steady growth aligned with their overall financial well-being. The correct answer is D. Conduct a comprehensive review of the client's entire financial situation, risk tolerance, and long-term objectives. Then recommend a diversified investment strategy that, while potentially slower, prioritizes capital preservation and steady growth aligned with their overall financial well-being. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the client's immediate financial needs with the fiduciary duty to act in their best interest, considering long-term implications and regulatory compliance. The advisor must navigate potential conflicts of interest and ensure that recommendations are suitable and not unduly influenced by external pressures or personal gain. The specific context of Ontario's regulatory framework for financial advisors adds a layer of complexity, demanding adherence to rules designed to protect investors. Correct approach analysis. The best professional practice involves a thorough assessment of the client's financial situation, risk tolerance, and investment objectives, followed by a recommendation that aligns with these factors and the client's stated goals, even if it means a slower accumulation of wealth. This approach prioritizes the client's long-term well-being and adheres to the principles of suitability and fiduciary duty mandated by Ontario securities law, such as those found in National Instrument 31-103 registration requirements, exemptions, and ongoing registrant obligations. This ensures that advice is objective and serves the client's best interests above all else. Incorrect approaches analysis. Recommending a high-risk, short-term investment strategy solely to meet an immediate, albeit stated, goal without a comprehensive suitability assessment fails to uphold the fiduciary duty. This approach disregards the potential for significant capital loss and the client's overall financial health, violating the principle of acting in the client's best interest. Furthermore, prioritizing a product that offers a higher commission, even if it's not the most suitable for the client's long-term objectives, constitutes a conflict of interest and a breach of regulatory obligations. Such a recommendation would likely contravene the requirement for registrants to deal fairly, honestly, and in good faith with clients. Focusing only on the client's stated desire for quick returns, without exploring the underlying reasons or potential consequences, ignores the advisor's responsibility to provide comprehensive and prudent financial guidance. Professional reasoning. Professionals should employ a structured decision-making process that begins with a deep understanding of the client's complete financial picture, including their stated goals, underlying needs, risk capacity, and time horizon. This should be followed by an objective evaluation of various investment options, considering their suitability and alignment with the client's profile. Any potential conflicts of interest must be identified and managed transparently. The final recommendation should be clearly justifiable based on the client's best interests and regulatory requirements, with all advice documented thoroughly. Question 15. The monitoring system flags a vehicle inspection report where a technician noted a minor but potentially safety-compromising issue with a vehicle's braking system during a routine safety inspection in Ontario. The vehicle owner, who needs the vehicle for immediate work, has requested the technician to pass the inspection, promising to address the braking issue later. The technician is aware of the owner's urgency and has the authority to issue the safety standard certificate. Which of the following actions best upholds the technician's professional and regulatory obligations under Ontario's Highway Traffic Act? Option A. Issue the safety standard certificate, but only after the owner signs a waiver acknowledging the braking system defect and their responsibility for any future issues. Option B. Pass the inspection, advising the owner to have the brakes checked by another mechanic at their earliest convenience and complete the safety standard certificate without further documentation of the defect. Option C. Issue the safety standard certificate as requested by the owner, noting the braking system issue in the report with a verbal assurance from the owner that it will be addressed soon. Option D. Document the braking system issue thoroughly in the inspection report. Explain to the owner that the vehicle cannot pass a safety inspection without the issue being rectified, and refuse to issue the safety standard certificate until the repairs are completed and re-inspected. The correct answer is D. Document the braking system issue thoroughly in the inspection report. Explain to the owner that the vehicle cannot pass a safety inspection without the issue being rectified, and refuse to issue the safety standard certificate until the repairs are completed and re-inspected. Explanation. The monitoring system demonstrates a potential gap in ensuring compliance with Ontario's Highway Traffic Act, HTA, regarding vehicle safety inspections. The scenario is professionally challenging because it requires the technician to balance the immediate need to complete a task with the overarching legal and ethical obligation to uphold public safety. A failure to correctly identify and address a safety defect can have severe consequences, including accidents and potential harm to individuals. The best professional practice involves a thorough and documented inspection process that prioritizes safety and adheres strictly to the HTA's requirements for safety standard certificates. This approach ensures that all mandated checks are performed, any identified defects are properly recorded and communicated to the vehicle owner, and the vehicle is only cleared for use once it meets the legal safety standards. This aligns with the HTA's intent to protect road users by ensuring vehicles are in safe operating condition, an approach that overlooks or downplays a potential safety defect, even if the vehicle owner expresses urgency or offers to pay for the inspection without immediate repairs, is professionally unacceptable. This failure to adhere to the HTA's safety standards constitutes a breach of regulatory requirements and ethical duties. Similarly, accepting a verbal assurance from the owner about future repairs without documenting the defect and ensuring it is rectified before issuing a safety standard certificate is a violation. This bypasses the established process designed to guarantee vehicle safety and could lead to the issuance of a certificate for an unsafe vehicle. Professionals should employ a decision-making framework that prioritizes regulatory compliance and public safety above all else. This involves understanding the specific requirements of the HTA, conducting inspections diligently and without compromise, documenting all findings accurately, and communicating clearly with the vehicle owner about any necessary repairs. When faced with pressure to expedite or overlook issues, professionals must recall their duty to uphold the law and protect the public, seeking guidance or escalating the matter if necessary. Question 16. During the evaluation of a driving test in Clare, an instructor observes a candidate make a minor lane change error, where the vehicle drifts slightly within the lane but does not cross any lines and poses no immediate danger to other road users. The instructor is aware that the test is nearing its end, and the candidate has otherwise performed competently. Considering the Clare Driver's Handbook assessment criteria, what is the most appropriate course of action for the instructor? Option A. Stop the test and provide immediate corrective instruction on lane changes before allowing the candidate to continue. Option B. Ignore the minor lane change error to ensure the candidate passes, as the test is almost over and the error was not dangerous. Option C. Record the lane change as a minor fault according to the Clare Driver's Handbook, continue the test to completion, and then assess the candidate's overall performance based on the total faults accumulated. Option D. Immediately fail the candidate for the lane change error, as any deviation from perfect lane discipline is unacceptable. The correct answer is C. Record the lane change as a minor fault according to the Clare Driver's Handbook, continue the test to completion, and then assess the candidate's overall performance based on the total faults accumulated. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the driving instructor to balance the immediate need to complete the test with the paramount duty of ensuring road safety and adherence to the specific requirements of the Clare Driver's Handbook. The instructor must make a judgment call under pressure, considering the potential consequences of both allowing a minor infraction to pass and unnecessarily failing a candidate who might otherwise be competent. This requires a deep understanding of the assessment criteria and the instructor's ethical obligations. Correct approach analysis. The best professional practice involves the instructor meticulously observing the candidate's performance throughout the entire test, noting any deviations from the Clare Driver's Handbook standards. If a minor infraction, such as a slightly hesitant lane change, occurs but does not compromise safety or significantly impede traffic flow, the instructor should record it as a minor fault. The instructor must then proceed with the remainder of the test, assessing all other aspects of the candidate's driving. At the conclusion, the instructor will evaluate the total number of faults against the Clare Driver's Handbook's pass/fail criteria. This approach is correct because it adheres strictly to the established assessment framework, ensuring a fair and comprehensive evaluation of the candidate's driving skills and knowledge of road rules as outlined in the Clare Driver's Handbook, without compromising safety. Incorrect approach is analysis, allowing the candidate to continue without noting the infraction, with the intention of making up for it later, is professionally unacceptable. This violates the principle of objective assessment and the integrity of the testing process. It could lead to a situation where a candidate who has demonstrated a pattern of minor errors, even if not explicitly failed for one, is still deemed competent. Furthermore, failing to record the infraction means the candidate does not receive feedback on a specific area for improvement, which is a key component of driver education. Another incorrect approach is to immediately fail the candidate for a single, minor infraction that did not pose a safety risk. While the Clare Driver's Handbook outlines fault categories, the assessment is holistic. A minor fault, by definition, is not a serious error that endangers others. Immediately terminating the test for such an infraction would be an overly harsh and disproportionate response, failing to assess the candidate's overall competence across the full spectrum of driving tasks required by the handbook. Finally, discussing the infraction with the candidate during the test and offering immediate corrective advice, rather than simply noting it as a fault, is also professionally unsound. The test is an evaluation, not a coaching session. Such an intervention could unduly influence the candidate's subsequent performance and compromise the objectivity of the assessment. The feedback should be provided at the conclusion of the test. Professional reasoning. Professionals in this role should employ a decision-making framework that prioritizes adherence to established regulations and ethical guidelines. This involves 1. Understanding the assessment criteria thoroughly, Clare Driver's Handbook. 2. Maintaining objectivity and impartiality throughout the evaluation. 3. Accurately recording all observed faults, categorizing them according to the handbook's guidelines. 4. Making a final judgment based on the cumulative assessment against the pass/fail standards. 5. Providing clear and constructive feedback at the conclusion of the test. This systematic approach ensures fairness, promotes road safety, and upholds the credibility of the driver licensing process. Question 17. In Ontario, Canada, if a client expresses a strong preference for an investment strategy that appears to significantly deviate from their stated financial goals and risk tolerance, what is the most appropriate course of action for a registered investment advisor to take? Option A. Refuse to consider the client's preferred strategy, informing them that it is not in their best interest without further explanation or discussion of alternatives. Option B. Engage in a detailed, documented discussion with the client to explain the risks and implications of their preferred strategy, present suitable alternatives, and ensure the final decision aligns with regulatory requirements for suitability and client best interests. Option C. Implement the client's preferred strategy, but minimize the discussion of associated risks in the client's file to avoid creating unnecessary concern. Option D. Immediately implement the client's preferred investment strategy as requested, assuming the client is fully informed and making their own decision. The correct answer is B. Engage in a detailed, documented discussion with the client to explain the risks and implications of their preferred strategy, present suitable alternatives, and ensure the final decision aligns with regulatory requirements for suitability and client best interests. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when that preference might lead to suboptimal outcomes or increased risk. The advisor must navigate this delicate balance, ensuring compliance with regulatory requirements while maintaining client trust. The best approach involves a thorough, documented discussion with the client about the implications of their preferred investment strategy. This includes clearly explaining the risks, potential downsides, and how it deviates from a diversified portfolio aligned with their stated financial goals and risk tolerance. The advisor should then present alternative, more suitable options that meet the client's objectives while adhering to regulatory standards for suitability and client care. This approach is correct because it upholds the advisor's fiduciary duty under the Ontario Securities Commission (OSC) regulations, specifically the client-focused market conduct rules. These rules mandate that advisors must act honestly, fairly, and in the best interests of their clients. Documenting this discussion and the rationale for recommendations ensures transparency and provides a defense against potential future complaints or regulatory scrutiny. It demonstrates due diligence and a commitment to client well-being, an approach that immediately implements the client's request without further discussion or explanation is professionally unacceptable. This fails to meet the OSC's requirement to act in the client's best interest and could expose the client to undue risk. It also bypasses the advisor's obligation to provide suitable recommendations based on a comprehensive understanding of the client's circumstances. Another unacceptable approach is to dismiss the client's preference outright and refuse to consider it without a detailed explanation. While the advisor may believe the preference is ill-advised, a complete refusal without engaging in a dialogue about the reasons behind the client's preference and educating them on alternatives can damage the client relationship and may not fully address the client's underlying concerns. The advisor should aim to understand the client's motivations before steering them towards more suitable options. Finally, an approach that involves implementing the client's preference but downplaying the associated risks in documentation is also professionally unsound. This constitutes a misrepresentation and a failure to provide accurate and complete information, violating the OSC's principles of fair dealing and honesty. Professionals should employ a structured decision-making process that prioritizes understanding the client's needs and objectives, assessing their risk tolerance, and then providing recommendations that are both suitable and compliant with regulatory requirements. This involves open communication, thorough documentation, and a commitment to acting in the client's best interest, even when it requires challenging the client's initial preferences. Question 18. Quality control measures reveal that a financial advisor in Ontario has observed a pattern of unusual and frequent withdrawals from the account of an elderly client, who appears increasingly disoriented during discussions about their finances. The client's adult child, who has power of attorney for property, is often present during these discussions and seems to be directing the client's financial decisions. The advisor suspects potential financial elder abuse. What is the most appropriate course of action for the financial advisor in Ontario? Option A. Continue to process the client's transactions as directed by the power of attorney for property, as the advisor has a duty to follow the instructions of the appointed legal representative. Option B. Immediately report the suspected financial elder abuse to the Ontario Securities Commission (OSC) and the client's power of attorney for property. Citing the unusual withdrawal patterns, Option C. Discreetly gather more information to confirm suspicions, potentially by reviewing recent transaction history for further anomalies and observing interactions between the client and their power of attorney, before considering reporting to the client's power of attorney for property or adult protective services if warranted. Option D. Directly confront the adult child about the suspected financial elder abuse and demand an explanation for the withdrawal patterns. The correct answer is C. Discreetly gather more information to confirm suspicions, potentially by reviewing recent transaction history for further anomalies and observing interactions between the client and their power of attorney, before considering reporting to the client's power of attorney for property or adult protective services if warranted. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial advisor in Ontario to balance client confidentiality with the potential need to report suspicious activity that could indicate financial elder abuse. The advisor must navigate the ethical obligation to protect client information against the legal and ethical imperative to safeguard vulnerable individuals from harm. This requires careful judgment to determine when and how to escalate concerns without breaching trust unnecessarily. Correct approach analysis. The best professional practice involves discreetly gathering more information to confirm suspicions before taking action. This approach prioritizes understanding the situation fully, respecting client confidentiality as much as possible, while still being vigilant. If suspicions are confirmed, the advisor can then proceed with appropriate reporting mechanisms, such as contacting the client's designated power of attorney for property or, if necessary, reporting to Adult Protective Services in Ontario, ensuring a measured and justified response. This aligns with the ethical duty of care and the regulatory framework in Ontario that encourages reporting of suspected abuse. Incorrect approaches analysis. One incorrect approach is to immediately report suspicions to authorities without further investigation. This breaches client confidentiality unnecessarily and could damage the client relationship and the advisor's reputation if the suspicions are unfounded. It fails to uphold the principle of proportionality in action. Another incorrect approach is to ignore the suspicious behavior due to a desire to avoid conflict or potential repercussions. This is ethically unacceptable, as it neglects the advisor's duty of care to a vulnerable client and could facilitate ongoing abuse, violating professional standards and potentially Ontario's elder abuse prevention guidelines. A third incorrect approach is to directly confront the client's caregiver about the suspicions without involving the client or appropriate authorities. This could escalate the situation, put the client at further risk, and potentially lead to retaliation or obstruction of any necessary investigation without a clear mandate to do so. Professional reasoning. Professionals should employ a tiered approach to suspicious activity. First, observe and document. Second, discreetly seek clarification or additional information from the client, if appropriate and safe. Third, consult with supervisors or compliance departments to discuss the situation and potential next steps. Fourth, if suspicions remain and indicate potential harm, escalate to the appropriate designated individuals or authorities as per provincial guidelines and internal policies, always prioritizing the client's safety and well-being. Question 19. The control framework reveals that a financial advisor in Ontario, Canada, has received instructions from a long-standing client to significantly increase their investment in highly speculative assets, a move that appears to contradict the client's previously documented moderate risk tolerance and stated long-term retirement goals. Which of the following actions best aligns with the advisor's professional obligations? Option A. Override the client's instructions and maintain the existing investment portfolio, believing that the advisor knows what is best for the client's long-term financial security. Option B. Immediately execute the client's instructions to increase investment in speculative assets, as client instructions are paramount and must be followed without question. Option C. Document the client's instruction and proceed with the investment without further discussion, assuming the client has fully considered the risks involved. Option D. Engage in a detailed discussion with the client to understand the reasons behind this change in investment preference, reevaluate their risk tolerance and financial goals, and clearly explain the potential implications and suitability of the proposed investment strategy in light of regulatory requirements. The correct answer is D. Engage in a detailed discussion with the client to understand the reasons behind this change in investment preference, reevaluate their risk tolerance and financial goals, and clearly explain the potential implications and suitability of the proposed investment strategy in light of regulatory requirements. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, must navigate conflicting client instruction regarding investment risk tolerance. This situation is professionally challenging because it pits the advisor's fiduciary duty to act in the client's best interest against the client's direct, albeit potentially ill-informed, instructions. The advisor must exercise careful judgment to balance these competing obligations, ensuring compliance with regulatory requirements and ethical standards. The best professional practice involves a thorough reassessment of the client's risk tolerance and financial goals, followed by a detailed discussion to educate the client on the implications of their requested investment strategy. This approach prioritizes the client's long-term financial well-being and adherence to regulatory principles. Specifically, under Ontario's securities regulations and the ethical codes of conduct for financial advisors, such as those enforced by the Mutual Fund Dealers Association of Canada or the Investment Industry Regulatory Organization of Canada, advisors have a duty to ensure that investments are suitable for their clients. This suitability requirement extends beyond simply following client instruction. It mandates that the advisor independently assess whether the proposed course of action aligns with the client's financial situation, investment objectives, and risk tolerance. If a client's instructions appear to contradict their established risk profile or financial goals, the advisor must investigate further, explain the risks, and potentially refuse to execute the instruction if it would be detrimental to the client. An approach that immediately executes the client's instruction without further inquiry or discussion fails to uphold the advisor's duty of care and suitability obligations. This could lead to investments that are too risky for the client's actual capacity to bear losses, potentially resulting in significant financial harm and regulatory sanctions for the advisor. Another unacceptable approach involves overriding the client's instructions based solely on the advisor's personal opinion of what is best, without a clear and documented rationale tied to the client's established profile and regulatory suitability requirements. While the advisor has a duty to advise, they do not have the right to unilaterally dictate investment decisions against a client's informed wishes, provided those wishes do not lead to demonstrably unsuitable or illegal outcomes. Finally, an approach that involves simply documenting the client's instruction and proceeding without any attempt to understand the underlying reasoning or potential consequences neglects the advisor's proactive role in client protection. This passive approach can be interpreted as a failure to exercise due diligence and a disregard for the client's best interests. The professional reasoning process for such situations should involve 1. Identifying the conflict between client instruction and established client profile/regulatory requirements. 2. Seeking clarification from the client to understand the rationale behind their instruction. 3. Educating the client on the potential risks and consequences of their requested action, referencing their established risk tolerance and financial goals. 4. Documenting all discussions, advice provided, and the client's final decision. 5. If the instruction remains unsuitable and potentially harmful, refusing to execute the instruction and clearly explaining the regulatory and ethical basis for this refusal, potentially recommending the client seek advice elsewhere. Question 20. Process analysis reveals that a financial advisor in Ontario is tasked with reporting the performance of a client's investment portfolio over the past year. The portfolio experienced several significant client contributions and withdrawals throughout the year. The advisor needs to present a performance figure that accurately reflects the investment manager's skill, independent of the client's cash flow activities, and complies with Ontario Securities Commission (OSC) regulations. If the portfolio's returns for the first quarter were 5%, the second quarter were -2%, the third quarter were 7%, and the fourth quarter were 3%, and these quarterly returns are calculated after accounting for all income and expenses within each quarter, what is the correct time-weighted rate of return, TWRR, for the year, expressed as a percentage, rounded to 2 decimal places? Option A, 12, 80%, option B, 13, 00%, option C, 13, 75%, option D, 13, 49%. The correct answer is D, 13, 49%. Explanation: scenario analysis. This scenario is professionally challenging because it requires a financial advisor to balance client needs with regulatory obligations, particularly concerning the accurate calculation and disclosure of investment performance. Misrepresenting performance can lead to significant client dissatisfaction, regulatory sanctions, and reputational damage. The advisor must demonstrate a thorough understanding of the specific calculation methodologies permitted and required by the Ontario Securities Commission (OSC) to ensure transparency and fairness. Correct approach analysis. The best professional practice involves calculating the investment's performance using the time-weighted rate of return (TWRR) method, as mandated by OSC guidelines for performance reporting. This method neutralizes the impact of cash flows, allowing for a fair comparison of the investment manager's skill over different periods. Specifically, the TWRR is calculated by dividing the portfolio into sub-periods based on the dates of external cash flows. The rate of return for each sub-period is calculated, and then these sub-period returns are geometrically linked to produce the overall TWRR. For example, if a portfolio has 2 sub-periods with returns /R1/ and /R2/, the TWRR would be /1 plus R1, 1 plus R2, 1/. This approach adheres to OSC Rule 31-505 regarding the fair presentation of investment performance and ensures that clients are not misled by the timing of their contributions or withdrawals. Incorrect approaches analysis. One incorrect approach is to calculate the money-weighted rate of return, MWRR, also known as the internal rate of return, While MWRR reflects the investor's actual experience by considering the timing and size of cash flows, it is not the standard for reporting investment manager performance under OSC regulations because it can be skewed by the investor's decisions rather than the manager's skill. For instance, if a client makes a large deposit just before a period of strong returns, the MWRR will appear higher than the TWRR, creating a potentially misleading impression of the manager's consistent ability. Another incorrect approach is to simply average the monthly returns without accounting for compounding. This method, often referred to as the arithmetic mean of returns, fails to accurately reflect the cumulative performance of the investment over the entire period. The formula for the arithmetic mean is \frac sum I equals 1 nRin where \ri is the return for month I and n is the number of months. This method ignores the compounding effect inherent in investment growth and can significantly understate or overstate the actual performance, violating the OSC's requirement for accurate performance reporting. A further incorrect approach is to present only the total percentage gain from the initial investment to the final value, ignoring all intermediate cash flows and the time value of money. This method, essentially a simple total return calculation without time weighting, is highly susceptible to the timing of cash flows. For example, a large deposit made just before a market downturn would artificially reduce this simple total return, while a withdrawal before a rally would inflate it, failing to provide a consistent and comparable measure of performance as required by the OSC. Professional reasoning. Professionals should adopt a systematic approach to performance calculation. First, identify the applicable regulatory framework, in this case, OSC guidelines. Second, determine the appropriate calculation methodology, TWRR, for manager performance. Third, gather all necessary data, including beginning and ending portfolio values, all external cash flows with their dates, and any income or expenses. Fourth, apply the TWRR formula meticulously, ensuring accurate sub-period calculations and geometric linking. Finally, ensure all disclosures are clear, transparent, and comply with regulatory requirements, including any necessary disclaimers.